Unemployment is at a half-century low, and inflation is running close to but a bit below our 2% objective. While not everyone fully shares economic opportunities and the economy does face some risks, overall, the economy is, as I like to say, in a good place. Our job is to keep it there as long as possible. While we believe our strategy and tools have been and remain effective, the U.S. economy, like other advanced economies around the world, is facing longer-term challenges, from low growth, low inflation, and low interest rates. While slow growth is obviously not good, you may be asking, what's wrong with low inflation and low interest rates? Low can be good, but when inflation and consequently interest rates are too low, the Fed and other central banks have less room to cut rates to support the economy during downturns. So in this review, we are examining strategies that might better allow us to symmetrically and sustainably achieve 2% inflation. Doing so would help prevent inflation expectations among consumers, businesses, and investors from slipping too low, as they appear to have done in several advanced economies around the world. More firmly anchored expectations in a virtuous circle would help keep actual inflation around our target, thus preserving our ability to change interest rates as appropriate to meet our mandate. We're also looking at whether our existing monetary policy tools will be adequate when the next downturn comes. Finally, we're asking whether our communications practices can be improved to better support the effectiveness of our policy. After today, we have 2 Fed Listens sessions remaining, both later this month, one in Kansas City and another in Chicago. At the July meeting of the Federal Open Market Committee, my colleagues and I began discussing what we've learned so far in these sessions. We continue that discussion at our September meeting and have a lot of work left to do. We plan to publicly report our conclusions during the first half of next year. One clear takeaway of the sessions so far is the importance of sustaining our historically strong job market. People from low and moderate income communities tell us that this long recovery, now into its 11th year, is benefiting them and their neighbors to a degree that has not been felt for many years. Employers are partnering with community colleges and nonprofit organizations to offer training, and people who have struggled to stay in the workforce in the past are getting new opportunities.